Give us a sense of the business environment and what you've been able to do this year with so many headwinds coming from the global pandemic.
Yes, look, I think the pandemic has been one challenge that we've had, but if you hark back 12 months in Australia, we had horrific bushfires. And as an insurance company, we had to deal with them. We had to get our claims sorted, get the customers that rely on us so much back in their homes. That was the first issue we dealt with. Then we dealt with the pandemic. Luckily, we went into the pandemic with a very strong balance sheet, really solid foundations. And out of the COVID, we have become much stronger. So while our net profit was down, that's a function of our prior comparative period having some one-off gains on sale. Our cash earnings for this period relative to the last period are up by 40%. We've seen double-digit increases in all three of our businesses. We were able to pay an equivalent dividend this half relative to the prior corresponding period, which I think is a really good outcome given all the things that have been thrown at us over the past 12 months.
Well, absolutely. I mean, low interest rates, also hazard claims here as well. Depressing your insurance margins, no doubt, here as well. I think they're well below your 10 to 12% target. How do you get them back up again to those levels?
Yeah, I think the function on insurance margins is quite a simple one, because over the past sort of decade or so in Australia, we've seen increased frequency and severity of natural hazards, and that's reflected in higher allowances and increased costs of reinsurance, and they go straight through your margin. The answer to getting your margin back to where it needs to be is a combination of appropriate levels of pricing, and we are repricing our home insurance book to take account of that. But also, pricing can't do everything, so we have to make our business more efficient. We have to have a best-in-class claims capability, so we have to service our customers through claims as good as anyone in the world, and that's what we're aspiring to. And we have to fundamentally overhaul and improve our underwriting so that our loss ratios improve and that we can get that margin back into that 10 to 12% range.
Well, absolutely. And, I think you have to achieve a 50% cost-to-income ratio for the bank at least. And where are you in trying to get to that cost-to-income ratio? Because I think you want to meet a 8.5% to 9% return on equity, which is your target.
Yeah, the cost-to-income ratio target that we have is a function of what we need to deliver to have our bank earning above its cost of capital. Now, a cost-to-income ratio fundamentally means two things. You've got to be focused very much on your expense base and making sure your expense base is very efficient and that you're using digital activity to service your customers so that you can bring down the cost to serve. But very importantly, you have to be growing your revenues. And we've done a really good job on the deposit side. We've got more work to do on the lending side. We have to improve the way we originate and service home lending and bring down our turnaround times and automate more of our lodgement processes so that we can substantially outperform on the home lending side, lift our revenue, reduce our costs, and that's the pathway to get to a 50% cost-to-income ratio.
Steve, talk to us about your 3-year plan and how that will improve your efficiencies.
Yeah, look, it's a very important transformation for us, and the catalyst for it was COVID. So obviously COVID was a very threatening experience for a lot of financial services companies, and we weren't alone. But we had a strong business, a strong balance sheet. So once we worked our way through the threats of COVID, we saw the opportunity. The opportunity was twofold. First one was we were working differently as a team. We were doing things that we never thought we could do in a more agile way. And our customers were interacting with us differently and more digitally. So we've taken the opportunity to bring forward some spending. There's some things that we can do so that we can meet more of our customers' needs through digital and we can automate more of our business. And we're going to do that over the next 3 years, and we think the payback is substantial, and the payback will go very much to the sorts of targets that we put in the market today. And that gives us confidence that we can deliver.
You're operating in a low-rate environment, and this environment is expected to persist for some time. To what extent can your insurance and banking volumes help provide that buffer?
Yes, look, certainly low-rate environments for insurance businesses are very challenging because you have a very big investment book that sits alongside and it's not getting appropriate levels of return. So we've got to make sure that we're pricing for that low-rate environment so that the returns that we typically get out of our invested funds are not where they usually would be. And so pricing is a big dynamic. But fundamentally, the best way to improve margins in our business and get to our return targets is to make our business as efficient as it can be. And that's why we're focused on improving claims, improving underwriting, improving the way we originate home loans, simplifying our business, cleaning up legacy portfolios, and really focusing on what is core to the group, and having every single person at Suncorp focused on improving the performance of an insurance company and a bank.
Steve, I'm just wondering, how are your numbers reflecting the state of the Australian economy, which is expected to pick up speed, accelerate in the coming year?
I think the numbers that we're putting in the market today should be a good reflection of a reasonably buoyant economy in Australia. Now we're hoping that the next sort of big benchmark sorts of considerations will be the removal of some of the government stimulus, whether that be JobKeeper and JobSeeker, reductions in JobSeeker through the next couple of months. We're very much watching what happens there. But we've seen a very buoyant economy in terms of origination of home insurance, particularly motor insurance. We've been growing our portfolio at 2.5% in terms of underlying unit count, and we're getting 3.5% of premium growth on top of that. So, the numbers that we're presenting today are very, very attractive and very sustainable, we think. So I guess the one question that sits on everyone's mind is, how is the economy going to react to the removal of the stimulus? And we'll find that out soon enough.
Quickly, Steve, are you taking the opportunity to look at some acquisitions at the moment?
Look, our fundamental principle at Suncorp is organic growth, and we've got a big runway of opportunities there. We don't necessarily get involved in speculating about what may or may not be involved in organically, but certainly we've got enough to do, enough on the slate organically that keep us busy for the next 3 years.